We also grew tangible book value per share. Tangible book value per share of 3.2% from the prior quarter to $18.73, and improved tangible common equity to tangible assets to 9.05%. These are high-quality results, and we believe the quarter demonstrates the strength of the franchise. While earnings remain strong, the most important financial takeaway was balance sheet quality. Reduced non-performing assets by 68.3%, increased tangible book value per share, and returned meaningful capital to shareholders through dividend increases and share repurchases. We are proud of our over 40-year history of returning capital to our shareholders, especially in the form of dividends. Let's turn to page 16 to talk about earning assets. Loans were stable during the quarter as new production offset planned balance sheet actions and reductions in non-performing loans. We continue to see healthy client activity and pipelines remain robust. The investment portfolio increased $5.9 million, or 0.8% from the prior quarter, as paydowns and maturities were replaced with new investments. We continue to benefit from reinvesting paydowns at higher front book yields. Our balance sheet is positioned neutrally for interest rates due to strategic loan and investment portfolio repositioning. In a 100 basis point increase or decrease scenario, we do not expect NII to be significantly impacted. While future rates remain uncertain, we believe that the balance sheet is positioned appropriately across a range of rate scenarios. Turning to deposits on page 17, total deposits decreased $156 million, or 3.6% from March 31st, 2026. The decrease was primarily driven by seasonal outflows of public depositor funds. Despite the seasonal outflows, our loan-to-deposit ratio was 96.2%. Deposit costs remain stable, and the mix of relationship-based deposits remains a key strength of the franchise. Synergistic deposits now represent 22.6% of total deposits and continue to provide a meaningful funding advantage. Those synergistic deposits grew 3.3% over the prior year, primarily from low-cost HSA deposits. Their continued contribution reinforces the strategic value of our integrated banking, wealth, retirement, and benefit services model. Our synergistic deposit franchise remains one of the strongest competitive differentiators in our business model and continues to provide a funding advantage that is difficult for many peers to replicate. This matters in the current environment where deposit quality, stability, and cost discipline remain top priorities. Turning to page 18, net interest income increased 6.2% to $47.7 million, and reported net interest margin increased 3.97%. Core margin remained stable from the prior quarter, which we view as a strong outcome given the current operating environment. Reported results benefit from purchase accounting accretion and the resolution of a non-performing loan, but overall